I can remember I was sitting in my cube. I could hear the sounds of champagne corks popping, people high-fiving each other, and we were all happy because we'd done what every startup in Silicon Valley wanted to do. We had just had our IPO. And people just got happier because over the next few months, because the stock kept going up and up. And I thought to myself, oh, if this keeps happening, then I'm going to be able to retire in my late 20s. Well, those of you who know history know that the dot-com bubble burst. I was at a dot-com company shut down, and all the employee equity that I held went to zero. Now, a couple important things came out of that. First, I realized I needed to educate myself about how my employee equity worked. And then the second thing is I ended up making a career change into financial planning. And the reason I started this firm today is because I want NVIDIA employees like you who've worked hard for the equity, make sure they get the most out of it. And that's why I built this firm today, and that's why we're here talking today. All right, so let me share some slides with you. Okay, again, we're going to talk about 4 tax strategies to diversify your NVIDIA without triggering a huge tax bill. For educational purposes, you should always talk to your own professional. Here's the agenda. Tell you just a bit about my background, and we're going to talk through the 4 strategies, which include direct indexing, long-short direct indexing, exchange funds, charitable remainder, Unitrust. And then we'll talk about how do you decide which strategy makes sense for you. And at the end, there'll be some live Q&A. So I expect this will take 25, 30 minutes or so. We'll have live Q&A. So as we're going through this, if you have questions, feel free to drop them into the chat. And I'll answer them there, or we'll just do live Q&A. Now, for those of you, I've done a number of these webinars. Some people are happy to ask their questions during the live Q&A. Others prefer a more private setting. So I'm happy to, for people who prefer a private setting, answer their specific questions. If you look now, you should see a red Schedule Now button. You click on that. It'll take you to my calendar. You can put time on my calendar, and we'll to set up a Zoom. We'll have a Zoom chat, and we can talk about your free personalized, diversify your NVIDIA strategy session. Okay, so let's get going here. So again, I worked in tech about 20 years. I've been doing this more than a decade in financial planning. I specialize in helping tech people with equity, including NVIDIA employees. All right, so let's talk about the 4 tax strategies to diversify your NVIDIA. So here's a typical NVIDIA client case study. So clients worked at NVIDIA for about 12 years. They plan to keep working there. They currently hold about 20 million in NVIDIA RSUs and ESPP, have lots of capital gains in those shares, and they want to diversify out of the NVIDIA, but they prefer not to pay a lot of taxes when they do that. So we would start with a couple of high-level issues. First of all, we want to understand how concentrated you are in NVIDIA. And that just means you take the current market value of your NVIDIA shares, RSUs and ESPP, and you calculate what percentage of your total investable assets it is. So that would include things like 401k, retirement, other investments, savings, cash. So if it is more than 20%, then you're highly concentrated. That's my guideline. And you should think seriously about diversifying out of it, because there's just a ton more risk in that. And then we would develop a financial plan, and we'd identify your key goals. And those could be things like want to buy a house. I want to pay for college for my kids. I want to get to financial independence as early as I can. And then we would understand, okay, how are we going to use this NVIDIA to achieve those goals? And then we'd decide how we're going to diversify it. So the baseline strategy, and often the simplest, cleanest thing to do, is what I call sell and pay your taxes strategy. That is, you just sell your NVIDIA, you pay your taxes. It's very simple. You're immediately diversified, and there's no hassle around it. Okay. Now, there are ways to minimize your taxes when you do this. So for your RSUs, for example, when you vest, you pay ordinary income tax rate on that the day you vest, the price of the stock, value of the stock when you vest. Okay. Now, when you sell, you pay tax on the capital gain, the difference between the price you vested at, the price you sell it at. So, for example, if you vested $100 a share and it's 110 when you sell it, that $10 gain, the $100 is taxed at ordinary income. The $10 is taxed at the capital gains rate. And then if it is less than or equal to a year, you pay what's called short-term capital gains. And for federal, that means it's the same as ordinary income. Your taxes could be as much as up to 37% for the federal taxes. If it's more than a year, it qualifies for long-term capital gains, which is lower. The highest rate is 20% for federal. So that means just by selling long-term versus short-term, you can save up to 17% in taxes. So if you got $1 million, that could be $170,000 less in taxes. So the steps to do this, to minimize taxes, is you just identify which RSUs have long-term cap gains, okay? And then start selling the RSUs that have the smallest gains, and end with the ones that have the highest gains, okay? Because you want to minimize your taxes. And then if you have RSUs with short-term gains, you can either hold them until they qualify for the long-term cap gains, or if you're ready to sell now, just start with, again, the smallest gains and end with the highest gains. That's how you minimize taxes on the RSUs. For ESPP, so Employee Stock Purchase Plan, it's a little different. As a reminder, that's an employee benefit. You can buy discounted NVIDIA stock by deferring a certain percent from each paycheck. Do it for 6 months. At the end of 6 months, you buy stock at a discounted price. Now, for ESPP, the tax treatment's different from RSUs. You pay ordinary income tax, up to the 37% on federal, unless you meet the two criteria below. It's got to be more than 1 year after the purchase date, right? And then more than 2 years after the grant date. That's the beginning of the offering period, or of that 6-month period when the ESPP starts. So if you meet both of those, then you can pay this lower long-term capital gains tax rate of highest is 20%. Again, save 17% by selling the long-term versus the short-term capital gains. And the way to do this is identify which one have long-term cap gains. Same thing. You can actually compare your ESPP gains to your RSUs, and then sell the shares, the type of shares that have the smallest gains, and then end with the highest gains. And then again, if you have ESPP with short-term gains, wait until they qualify for long-term cap gains, or you can, if you need to sell them at short-term, start with the smallest, end with the highest gains. So that's the baseline. Okay, so the first strategy we're going to talk about is called direct indexing. Okay. Background to understanding this is when you take losses on any investment, the IRS lets you use those losses to offset gains. Okay. So for example, if I buy a stock at $100 a share, I sell it for 90, then I have a $10 loss per share, and then I can use it to offset a $10 gain by selling a different investment. So direct indexing uses what's called tax loss harvesting. And that's the strategy where you take losses on purpose intentionally to offset gains, and so you can save on taxes. Okay. So the way the strategy works is you match an index. So for example, let's say you match the S&P 500. But instead of buying an ETF or mutual fund, you buy individual stocks. So you may buy a couple of hundred individual stocks that will track the S&P 500. But what happens is this gives you more opportunities for tax loss harvesting, because even when the market is up or the is up, some stocks are down. So for example, the S&P 500 was up about 23% in 2024, but there were more than 100 stocks of the 500 that were down more than 5% at some point during the year. So what happens is, even if the S&P 500 is up, what happens is we identify which stocks are down, sell those, you capture the loss, and then we typically buy a similar stock so that you stay invested. So it can still track the S&P 500. But you're able to capture losses that you wouldn't be able to do with an ETF or a mutual fund. So the question is, well, how does this work exactly? Well, what you can do is you can take your NVIDIA proceeds, put in a direct index portfolio in what's called a separate managed account. You harvest your tax losses, and then you can sell NVIDIA with gains and use up those harvested tax losses. And then now you've sold some new NVIDIA, then you put it into the direct index portfolio, and then you can just repeat and sell as much NVIDIA as you can to use up these losses as you take them, and you pay $0 in taxes on those gains. Okay, that's how it works. And then how well does it work? Well, it depends a lot on the type of market. When markets are going down, you can take a lot more opportunity for tax loss harvesting. Goes up, there's less. So it depends on the market. But on average, this chart is showing you on average what you see. So this is saying, let's say you put in $1 million in a direct indexing portfolio. In year one, on average, you'd be able to take 11% or 110,000 in losses that you can then use to offset 110,000 in gains. Over five-year period, you'd be able to take about a third, so 310,000, and then over 10 years, almost half, so 470,000 in losses. So again, you take the losses, you take your NVIDIA gains, you pay no taxes on those gains. So that is how direct indexing works. Okay, there's a second strategy, which is a souped up version of direct indexing. It's called long short direct indexing. Okay, so a little background here. When you go long with stocks, that's what you normally do, is you buy stocks and you make money when the stock goes up. Okay, that's how we normally think of investing. You can also go short with stocks. Okay, and that means you're betting that stocks will go down, so you make money when stocks go down. All right, and most people don't do that. But there's what long short direct indexing is you do direct indexing, but it's a strategy that adds what's called a long short extension. That means you're taking some margin to be able to go long, more long on the portfolio, and also short. So the key benefit is that when you do a long short extension, you get more opportunities for tax loss harvesting, because you can take losses both when markets go up and when they go down. So for example, when stocks go down, you take losses on going long, just like you would with normal direct indexing. When stocks go up, you take losses on going short because you have been betting they're going to go down, but they went up, so you get losses on the short side. So again, some complexity there, but if you have specific questions, feel free to put time on my calendar, schedule now button. So let me show you a picture to try to give you an idea. So this is the typical long only direct index. You put in $100. When you add the extension, what you do is you add margin. So you put in $100 margin, so you can buy about $30 more on the long side, and then add shorting of about $30. Okay. So more opportunities for tax loss harvesting. What exactly does that look like? Well, so this chart is saying if you did what's called a 130-30, which is 130% long, 30% short, what would that mean? And if you compare it to a typical direct index thing, long only, this chart is showing you over time how much in losses would you typically expect. So for example, in year one, when you do the long only, like we said, maybe about 11% in losses. But in the long short, you get up to, could be 20 something percent. Okay. And so what you see over time is the long short gives you more, higher percentage of tax loss harvesting, and then it also lasts longer. Okay. So that's because there are opportunities both when the market goes up and when it goes down. So that is long short direct indexing. Really, you think of it like souped up direct indexing. Okay, the third strategy is what's called exchange funds. Okay, so an exchange fund, it's a limited partnership for individuals who have highly appreciated concentrated stock that they want to diversify immediately without triggering taxes. Okay, so the way it works is you would take your NVIDIA shares, you would put them into this exchange fund, and then you get equal value of units of that fund. And there would be other individuals who have stock, right? And it could be somebody from Meta, or it could be somebody from Procter & Gamble. They put their shares in, and you get shares not just of NVIDIA, but you also get shares of Meta and Procter & Gamble. So you're immediately diversified because it's not a single stock, it's all the stocks you're holding. And you don't have, when it's in an exchange fund, you don't pay, taxes are not triggered. Okay, you're diversified immediately, taxes are not triggered. And then this exchange fund, typically they'll track a broader index like the S&P 500. Okay, so it's a great way, you get diversification, taxes aren't triggered. Now, some important trade-offs to understand, because there are trade-offs with all these, is it's illiquid. What that means is typically you got to stay in the fund for at least 7 years before you can get your assets out, and you're required to keep 20%. This is the IRS rule of the capital in illiquid assets like real estate. And then understand you are only able to defer your taxes. So when you put it in, you don't pay any taxes. 7 years later, you say, I'm going to take it out, you sell it, then you pay taxes at that time. Okay, so you can defer but not avoid. Okay, and then the fourth strategy is what's called the charitable remainder Unitrust strategy, which is better known as a CRUT. And this, the way this works, it enables you to diversify your NVIDIA. Okay, you get an immediate partial tax deduction. You pay no immediate capital gains. You get a yearly stream of income. And at the end, whatever's left, you donate to charity. Okay. And this is, again, the IRS requires you do need to donate to charity at the end after you're gone to make it to meet the requirements. So the steps to do this, how it works is you would gift your NVIDIA into the CRUT, and then you get this in that year, you get a partial charitable tax deduction because you are putting it into the CRUT, meaning you're donating it to the CRUT. And then the CRUT can sell the NVIDIA right away, and they don't have to pay any immediate capital gains because it's a tax-exempt entity. And then the CRUT can invest into those proceeds into a diversified portfolio, so you're immediately diversified. And then this CRUT pays you a fixed percentage of the value of this trust in every year for, you can choose, up to a lifetime. Okay. You can choose the period, but lifetime is typical. And then the charity receives what's left at the end. Again, important trade-offs are these assets are irrevocable, meaning when you put them into the CRUT, you can't take them back. Okay. They are in the CRUT. And you get this lifetime income, but again, you can't touch the assets. And also, you really need to want to give to charity because it is a requirement at the end. You do need to give some portion to charity. All right, so I've talked you through these 4 strategies. How do you decide on which one makes sense for you? Okay. The way to decide is how quick you want to look at ask yourself these questions. Okay. First is how quickly do you want to diversify out of NVIDIA? The second is how much hassle do you want to deal with? Because every strategy does require some hassle, some work on your part. And then what trade-offs are you willing to make? And then how much each of these strategies costs. There are costs to execute them. So how much are you willing to pay? So once you answer those questions, then you can figure out what the right strategy is. So for example, if I had a client come to me and said, okay, I want to immediately diversify, and I don't need the fund for 7 years, then I would say, okay, well, if that's the case, then it'd be reasonable to look at the exchange fund because you immediately are diversified. There's some hassle, but the big trade-off is you can't touch for 7 years. But since you're okay, then this is a very reasonable strategy to look at. On the other hand, if the client said, I thought about it, I really want to be able to, I may need to touch those assets, but I still want to meet diversification, then I would say, okay, well, then let's go to the baseline, sell and pay your taxes because you're going to get immediate diversification. Pay your taxes is a trade-off, but you have that cash available immediately. You can do whatever you want with it. Okay, low hassle and low costs. So you really need to answer these questions and determine which strategy would be the best fit for you and your situation. Okay, let's talk about next steps. Again, you want to talk about your specific situation, feel free to click on the schedule now, put time on my calendar. Happy to chat. And then before we do the live Q&A, I want to give you a quick happy past story. So I had a client come to me who was an NVIDIA employee, would plan to continue to work there. And we said, and the client said, hey, help us figure out what to do with this. So we figure out concentration, highly concentrated, probably 90% in NVIDIA. Then I defined the key goals that included wanted to buy a house, had kids, so want to make sure the kids' college was paid for, and then want to get financial independence as early as possible. So we looked at it. We figured out put together a selling plan that included a couple of these different strategies. And once we started to execute the plan, we were able to buy, the client was able to buy a house that they wanted, fund college for the kids. So the kids were taken care of. And then on track to get to financial independence early. And that's the opportunity that you have as an NVIDIA employee, is that if you do this correctly, then you can end up being able to use your NVIDIA, minimize your taxes, but still achieve all the goals that you want to achieve. That's what the happy path looks like. All right, so I want to take 1 second here or a minute here to see if there are any live Q&A questions. I'm checking the chat. Okay. Not seeing there. So let me just give you a moment here. If any questions, feel free to drop in the chat. Okay, I'm not seeing anything. Again, if you have questions, feel free to put them on my calendar and ask, or you can email me. So I want to thank everybody for coming. Everyone will get a recording of this webinar. If you found it helpful, feel free to share it with your NVIDIA coworkers. And again, thank you all for coming.